Hey everyone, welcome back to Corporate Decoded, the place where we uncover the stories hidden in plain sight within corporate filings. And today we're diving deep into CIM Real Assets and Credit Fund's latest report, a document that has got more twists and turns than a roller coaster, and we're going to decode it all for you. So what is the big picture here? This report is basically a deep dive into the fund's financial health as of the 30th of September 2025, and its strategy for generating income and growing shareholder value, all while navigating some pretty complex market risks. Think of it like a financial checkup for a specialized investment company. Before we get into the juicy details, if you appreciate straightforward financial breakdowns and want to understand the real story behind corporate reports, make sure you subscribe. We also have a fantastic community forming on Discord all about dissecting these filings, so check out the link in the description. Let's start with what they actually own. This is the heart of the report, and it shows us where the fund's money is invested. We're seeing a significant chunk in collateralized loan obligations, that is CLO debt, making up over 21% of their holdings. Then there is direct real estate at nearly 33%, followed by commercial mortgage. Backed securities at over 21%. It is a credit and real estate focused portfolio, as the name suggests. Looking at their biggest single holdings, saw a multifamily residential property accounts for 8% of the portfolio. Then we've got INTC 1 LLC at 6.4% and 127, 165 and 171 SLA BRIA at 5.3%. These top 10 holdings alone make up a substantial 44% of the entire portfolio. This tells us they are quite concentrated in a few key areas, which can be a double-edged sword offering high rewards, but also potentially higher risk if those specific investments falter. Now, this is interesting liabilities in excess of other assets at almost negative 18%. This indicates that the fund is using leverage, significant leverage, to amplify its potential returns. Think of it like borrowing money to invest more money, hoping to make more profit, but it also means the risks are amplified too. If their investments go down, this leverage magnifies those losses. Let's zoom in on some of these commercial mortgage-backed securities. We see investments like CPX Trust 2022, CXP1 Class E, and Extended Stay America Trust 2021, ESH Class F. These are complex financial instruments tied to real estate loans, and their value can swing quite a bit based on the underlying property performance and broader economic conditions. Moving on to derivative instruments, the report details their total return swap contracts. These are essentially agreements where the fund gets the return on an asset without actually owning it. They've got contracts with Citibank NA referencing various loans. While this can offer exposure without tying up as much capital, it also adds another layer of complexity and risk. For instance, the net unrealized depreciation on these swap contracts is over $3.3 million. That means these derivative positions have lost value. After accounting for all assets and liabilities, the fund's net assets stand at over $265 million. This is the actual value belonging to shareholders. Looking at the balance sheet again, we see the investments at fair value are over $311 million. They also have significant cash or cash collateral for total return swaps, totaling over $24 million. On the liabilities side, they have a substantial line of credit payable of $26 million and payable for reverse repurchase agreement of nearly $35 million. This confirms our earlier observation about significant leverage. The report breaks down the net asset value, or NAV, for different share classes. For Class A shares, the NAV is $21.96 per S-share, with a maximum offering price of $23.30, reflecting the sales load. Class I shares, the institutional class, have the highest NAV at $22.25 per S-share. Now let's look at how the fund made money and spent money in the year ending the 30th of September 2025. Total investment income was close to $28 million, primarily from interest income. However, expenses including management fees, incentive fees, and interest expense added up to nearly $19 million. After reimbursements from the advisor, they ended up with net investment income of about $14 million. They also saw a net realized loss on unaffiliated investments of over $500,000. But they had a gain on total return swap contracts and a significant change in unrealized appreciation on affiliated investments, which helped boost their overall net increase in net assets to over $22 million. That is a healthy jump, demonstrating growth in their overall holdings. When we compare the results to the previous year, the 30th of September 2024, the net investment income has decreased. This is despite a larger net increase in net assets this year. It suggests that while the overall value of investments grew a lot this year due to market appreciation, the income generated from those investments was lower than the previous year. It also highlights how much the fund relies on investment gains rather than just income generation. The statement of cash flow shows the movement of money. Operating activities generated over $32 million in cash. This is mainly due to the net increase in net assets as discussed. Financing activities, however, used over $31 million. This is largely due to increases and decreases in their line of credit borrowings and reverse repurchase agreement borrowings. Essentially, they are actively managing their debt to fund investments and operations. Now let's talk about the risks. These are crucial for understanding what could go wrong. We're seeing mentions of geopolitical and global economic risk, which is obviously very relevant with current world events. Then there is trade policy risk, highlighting potential disruptions to global trade. As a fund heavily invested in real estate and credit, naturally, there is a significant real estate industry risk. This covers everything from economic conditions and property values to rising interest rates and local competition. It is a reminder that real estate is not a stable asset class. When it comes to their commercial mortgage-backed securities, they highlight the specific risks of investing in the residual or equity tranches, which are the riskiest parts of these securities. They essentially get paid last if there are defaults, which means the potential for total loss is real. They also detail CLO risk, meaning collateralized loan obligations. The report warns about middle market loans, which are riskier than those from large public companies, and the increasing trend of covenant-light loans, meaning borrowers have more freedom and lenders have less protection if things go south. It is good to see the Board of Trustees is actively involved. They unanimously approved an amended sub-advisory agreement with Office Capital Management LLC, resulting in lower sub-advisory fees. This shows a focus on managing costs benefiting shareholders as well as the fund's performance. They reviewed nature, extent, and quality of services, investment performance fees, and the profitability of the advisors. Looking at leadership, David Thompson, Chairman of the Board and Chief Executive Officer, has been with the fund since 2019, and is also a principal at CIM Group, another important affiliation. Bilal Rashid, also a trustee, holds leadership roles at Accession Capital Corporation and its affiliates, demonstrating a strong connection between the fund and its advisory entities. Towards the end, we have the privacy policy, a standard disclosure about how they handle your personal information. They collect details like addresses, financial information, and communication records for business administration and service provision. They emphasize not selling your data, which is reassuring. Now for my take on CIM Real Assets and Credit Fund. This fund is clearly playing in the big leagues with a sophisticated strategy focused on real estate and credit. The significant use of leverage and investment in more complex instruments like CLOS and CMB's equity tranches suggest a higher risk tolerance aimed at generating attractive returns. The management team has deep experience in these areas, and the recent approval of lower sub-advisory fees is a positive sign for cost management. However, the risks outlined in the report are substantial. Geopolitical uncertainty, rising interest rates, and the inherent volatility of real estate and credit markets mean that NAV can swing significantly. The concentration in certain holdings and the reliance on leveraged instruments amplify both potential gains and losses. Their success hinges on skillful navigation of these risks and the overall health of the economy. In my opinion, CIM Real Assets and Credit Fund is a high-risk high. Reward play for investors who understand these complexities and are comfortable with the potential for significant volatility. It is not for the faint of heart, but for those seeking potentially higher yields in the current market environment. It is certainly worth considering. The use of derivatives and complex securities means investors need to do their homework. What are your thoughts on this report and the fund's strategy? Do these numbers and risks align with your investment outlook? Let me know in the comments below. If you found this breakdown insightful, please hit that like button. It really helps us out, and subscribe for more in-depth corporate analyses. And don't forget to join our Discord community linked in the description for more discussions and insights. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.